There's a moment that happens late, usually when the screens are off and the noise dies down, when you realize the numbers you've been watching no longer fit the story you've been telling yourself. Gold near $5,100. Silver above 108, not gradually, not after decades of grinding higher, but suddenly, decisively, as if a switch was flipped while most people were still debating whether the system was even stressed. The strange part isn't the prices themselves. It's how quickly the shock wears off, how fast disbelief turns into acceptance, and how easily acceptance turns into certainty. Just days ago, silver at 90 already felt stretched, uncomfortable, hard to justify, without reaching for extreme explanations. Now it's moved another 20% higher, and the conversation has shifted. What once sounded reckless is now spoken about calmly, as if it were always destined to happen this way. A year ago, hearing these levels would have triggered laughter, not because people didn't understand markets, but because history trained them not to expect generational moves compressed into months. Even as recently as late 2025, these prices would have felt disconnected from reality. Yet here they are, and the most dangerous change isn't in the charts, it's in the mindset. When moves happen this fast, people rush to explain them. Silver shortages, industrial demand, monetary debasement, currency collapse, each explanation sounds reasonable on its own. But the real question hides beneath all of them. Why is gold up nearly 20% in a single month and close to 100% over a year, while much of the world looks normal? Are gold and silver reacting to separate forces, or are they responding to the same underlying stress that hasn't fully revealed itself yet? When two monetary metals move together like this, history suggests it's rarely about the metals alone. This is where stepping back matters, because price alone doesn't tell you whether something is expensive or cheap. Relationships do, ratios do, context does. If there's no framework for when risk changes, if the assumption is that prices can simply keep accelerating without friction, that's usually when blind spots form. Gold and silver holders tend to be contrarian by nature. They accumulated quietly for years while prices stagnated and attention drifted elsewhere. But when people who never cared about metals suddenly rush in at record prices, history suggests caution, not celebration. Not because the move is over, but because the easy conviction has already been earned. One of the loudest narratives right now is that the dollar is heading towards zero, or at least toward a forced revaluation alongside other fiat currencies. To test that idea, it helps to look at how the dollar actually behaves relative to gold. The US dollar index measures the dollar against a basket of other major currencies, primarily the euro, the yen, and the British pound. For most of modern market history, the relationship was simple. When the dollar weakened, gold strengthened. That inverse relationship held through multiple cycles. In 2011, it made sense. The dollar index fell near 70. Gold surged. Fear was widespread. Today, the dollar index sits near 102, yet the language being used is even more extreme. Back then, €1 bought roughly $1.6, and many genuinely believed the euro would replace the dollar as the world's reserve currency. Cultural signals reflected that confidence. Luxury contracts, public displays of wealth, even media narratives shifted toward the euro. In hindsight, that moment marked the euro's peak, not its triumph. The gold-dollar relationship held until it didn't. And the break didn't come from economics alone. It came from geopolitics. When Russia invaded Ukraine and roughly $300 billion of Russian reserves held in Western instruments were frozen, something fundamental changed. Central banks around the world took notice. Before that moment, central bank gold purchases averaged around 100 tons per year. Afterward, the pace accelerated sharply. The lesson was quiet but powerful. Reserves held in someone else's currency come with conditions. Gold does not. Looking at the most recent data through late 2025, the largest gold buyers are not Western powers. Poland stands out, but beyond that, the list includes Kazakhstan, Brazil, Azerbaijan, Turkey, China, the Czech Republic, Ghana, Cambodia, and Iraq. The United States is absent. Germany appears far down the list and is notably a net seller. If Western governments truly expected an imminent currency reset designed to inflate away debt or transition into digital currencies, logic would suggest aggressive accumulation of gold using depreciating fiat. Public data doesn't show that. Could some accumulation be happening quietly? Possibly. Governments planning devaluation rarely advertise it, but even allowing for secrecy, another inconsistency appears. If the dollar were truly on the verge of collapse, gold and silver wouldn't be moving alone. Energy would not be lagging. Food would not be subdued. Real assets across the board would be repricing aggressively. That isn't happening. The gold-to-oil ratio exposes this clearly. In 2008, 1 ounce of gold bought roughly 6.5 barrels of crude oil. During the pandemic, when oil futures briefly went negative, that ratio spiked toward 90. Today, In relatively stable conditions, it remains in the mid-80s. Historically, equilibrium sits closer to 16 to 20. That means gold is extraordinarily expensive relative to energy. Silver tells a similar story. Even at its 1980 peak, near $50, silver only reached about 1.1 barrels of oil. Today, that ratio is closer to 1.6, while historical lows near 0.1 remind us how extreme current levels are. Energy prices themselves reinforce the point. Oil peaked near $140 around 2010, which equates to roughly $230 adjusted for inflation. Today, prices hover near $60. Natural gas tells the same story, falling from $13 to around $4. If the dollar were collapsing, energy would not be priced like this. Agricultural commodities confirm it. Wheat, corn, soybeans, rice, and oats remain well below their 2008 highs and even below the spikes of 2022. Soft commodities show similar restraint. Cocoa surged briefly, peaking near 12,000 in 2024, then fell toward 4,000. Dairy, livestock, and most food inputs remain within long-term ranges. None of this reflects a world abandoning the dollar wholesale. And that's where the tension quietly builds. Precious metals are telling one story. Almost everything else is telling another. When markets disagree this sharply, something eventually adjusts. The only question is, what moves and when? That disagreement is where things get interesting, because markets don't tolerate contradictions forever. When one group of assets prices in extreme stress while others remain anchored to normalcy, the imbalance doesn't resolve through opinion. It resolves through movement. Either the lagging assets reprice sharply, or the leading assets lose momentum. Sometimes both happen in stages, but what almost never happens is nothing. That's why moments like this matter more than the headlines suggest. They're not about prediction, they're about positioning. Real estate is a useful place to look next because, unlike metals, it sits at the intersection of credit, income, and confidence. Instead of asking whether homes are expensive in dollars, a more revealing question is how expensive they are in gold. When you measure the average U.S. home in ounces of gold using the Case-Shiller Index, the picture changes dramatically. Today it takes roughly 119 ounces of gold to buy the average home. That level has only been reached twice in the last 45 years. Once in 1980 during gold's blow-off peak, and once in 2011 in the aftermath of the housing collapse. In both cases, gold holders were able to exchange metal for real assets at historically favorable terms. To put that in perspective, in 2001 it took roughly 770 ounces of gold to buy the same average home. The same quantity of gold that now buys one house could have bought 6 houses then. That's not a statement about housing bubbles or affordability in dollar terms. It's a statement about relative valuation between assets responding to different pressures. Housing today is not priced as if the dollar is about to vanish. It's priced as if the system, however strained, is still functioning. Stocks tell a similar story. When you measure the Dow Jones Industrial Average in ounces of gold, you strip away currency illusion and focus on purchasing power. In 1980, 1 ounce of gold bought roughly 1 share of the Dow. By 2000, at the height of the dot-com era, it took nearly 40 ounces. In the years that followed, that ratio drifted lower. More recently, it hovered near 20. Today, it sits closer to 10. That's a substantial adjustment already. It suggests equities have lost significant ground relative to gold, even as nominal prices remain elevated. Could that ratio compress further? Possibly. Markets overshoot. But historically, the long-term equilibrium for the Dow to gold ratio tends to live in the high single digits to low teens. A return to 1 ounce per share would imply either a dramatic collapse in equities, an explosive continuation in gold, or both. That's not impossible, but it's not the default outcome markets usually choose. The same logic applies to the S&P 500 relative to gold. That ratio peaked during periods of extreme optimism and has since retreated toward historical norms. That doesn't mean stocks are cheap. It means gold has already done a large part of the rebalancing work. Silver's move has been even more dramatic. The Dow to silver ratio has fallen from nearly 1,800 ounces per share to roughly 500. That's not a small shift. That's a repricing event. This is where narratives become dangerous because they freeze thinking at exactly the wrong time. It's tempting to assume that because gold and silver have moved aggressively, everything else must follow in the same direction at the same pace for the same reasons. But markets don't move in moral alignment. They move based on incentives. Gold and silver respond to trust and confidence. Energy responds to supply, demand, and geopolitics. Housing responds to credit availability and demographics. Agriculture responds to weather and yield. When only one corner of the system behaves as if collapse is imminent, it deserves scrutiny. So what does this divergence actually suggest? It suggests that if any assets are currently priced as though the dollar is becoming worthless, It may not be commodities or real assets, it may be financial assets themselves. Equity indices continue to trade at elevated multiples despite slowing growth and tightening financial conditions. That implies optimism, not panic. Meanwhile, most commodities outside of precious metals remain subdued. They are not signaling hoarding behavior. They are not signaling desperation. They are behaving as though the system is stressed, but intact. That leaves an uncomfortable possibility. Either oil, natural gas, real estate, and food prices are about to surge dramatically to catch up with metals, or gold and silver have temporarily moved ahead of the reality that supports them. The answer may not be binary. Catch-up often happens unevenly, selectively, and over time, but relative value still matters, especially for anyone sitting on large, concentrated gains. At this stage, the question is no longer whether owning gold and silver was the right decision in the past. That question has already been answered by the price. The question now is what role those assets play going forward, and that depends less on macro forecasts and more on personal exposure. Someone holding 5 to 10% of their net worth in metals as insurance may do nothing. Insurance isn't meant to be optimized, but someone whose net worth is dominated by silver or gold is exposed to a very different set of risks. This isn't an argument against metals, it's an argument for optionality. Gold and silver are liquid. They allow you to exchange into other assets when ratios become extreme. That opportunity window doesn't stay open indefinitely. It appears briefly, often when sentiment is strongest and dissent is least welcome. Some may consider shifting silver into gold if the gold-silver ratio compresses further, rather than waiting for a perfect historical target that may never arrive. Others may look beyond metals entirely, toward energy equities, real estate, or simply converting gains into reduced liabilities or improved resilience. None of these choices invalidate the original thesis. They reflect adaptation, not betrayal. Predictably, these discussions trigger emotional responses. Whenever one side of a trade becomes crowded, questioning it invites accusations. We've seen this pattern repeatedly, from speculative technology manias to cryptocurrencies to short squeezes driven by collective conviction. Anyone who suggested taking profits early was dismissed, mocked, or accused of hidden motives. Markets don't care about loyalty, they care about balance. When gains become meaningful enough to change your future, preserving them becomes more important than defending a narrative. History is full of people who were directionally correct but tactically ruined because they refused to adjust when conditions shifted. That doesn't mean selling everything, it means thinking in probabilities, not certainties. And that's where the tension continues to build, because the higher prices go, the more emotionally expensive flexibility becomes. That emotional cost is what quietly reshapes behavior at late stages of powerful moves. When an asset stops being something you own and starts becoming something you are, adjusting exposure feels less like risk management and more like abandonment. Precious metals tend to create that dynamic faster than most assets because they're tied to identity as much as to price. They represent foresight, independence, and skepticism of centralized systems. None of that is inherently wrong, but when price action accelerates faster than underlying confirmation, those narratives can harden into blind spots. At that point, belief replaces analysis. Every pullback is dismissed as manipulation. Every hesitation is framed as weakness. Every alternative is treated as betrayal. That psychological shift is subtle, but it's critical because markets don't punish optimism. They punish rigidity. Flexibility is what survives transitions. Certainty is what gets tested. What makes this moment especially difficult is that there is no universal answer. The same price move that creates opportunity for one person creates vulnerability for another. Someone with diversified assets and modest exposure can tolerate volatility without consequence. Someone whose net worth is heavily concentrated in silver or gold is exposed to sequencing risk, regardless of long-term conviction. A temporary drawdown matters far more when liquidity and timing intersect with real-life obligations. That's why rotation, not liquidation, tends to matter more at moments like this. Historically, when silver dramatically outperforms gold, the gold-silver ratio compresses to levels that eventually reverse. In 2011, that ratio approached 30. Many waited for exact repetition, assuming history would cooperate precisely. It didn't. Markets rhyme, but they don't honor nostalgia. Waiting for perfection often becomes a way of avoiding action. Scaling decisions over time reduces regret, regardless of outcome. It preserves optionality. It allows adjustment without betting everything on a single forecast. That principle applies whether the shift is within metals or outward toward other assets that have lagged. Energy equities, for example, reflect not just commodity prices, but capital discipline, dividends, and replacement costs. Real estate provides utility and cash flow. Even reducing personal liabilities converts financial gains into psychological stability, though that rarely makes headlines. What complicates all of this is the surrounding noise. Late cycle environments are loud. Comment sections become echo chambers. Dissenting views are met with hostility rather than curiosity. The assumption emerges that anyone questioning the dominant narrative must be compromised, uninformed, or acting on behalf of unseen interests. That mindset isn't new. It shows up whenever a trade becomes crowded enough to feel inevitable. We've seen it repeatedly. In speculative technology cycles, in cryptocurrency surges, in collective short squeezes. Early skepticism was rewarded. Late certainty was punished. Anyone suggesting restraint near peaks was ridiculed, and yet, once momentum faded, silence replaced outrage. The pattern wasn't ideological, it was psychological. The irony is that the very traits that helped metals holders succeed early become liabilities later. Patience turns into stubbornness. Conviction turns into inflexibility. Skepticism of the system turns into faith in a single outcome. That's when risk quietly migrates, not away from metals themselves, but toward concentration and timing. None of this implies that gold and silver are finished. Trends often persist longer than logic expects, but it does suggest that the margin for error has narrowed. When assets are cheap, mistakes are forgiven. When assets are expensive relative to alternatives, mistakes are punished quickly and without warning. That asymmetry is what changes the decision-making environment, even if prices continue higher. So the real question isn't whether gold reaches higher levels next year or whether silver overshoots expectations again. The real question is how exposed you are to being wrong about the path it takes to get there. Volatility cuts both ways. Moves that arrive fast can reverse fast. Even if the long-term thesis remains intact, the journey matters. Optionality becomes the scarce asset in moments like this. Optionality means liquidity. It means flexibility. It means the ability to respond rather than react. Locking yourself into a single outcome, no matter how convincing it feels, removes that advantage. And markets are relentless about testing where conviction ends and fragility begins. History doesn't usually punish people for being early. It punishes them for refusing to adapt once success arrives. Sometimes that punishment comes through sharp reversals, sometimes through long periods of stagnation that quietly drain enthusiasm, sometimes through missed opportunities elsewhere that only become obvious in hindsight. The form changes, the lesson doesn't. So as gold and silver command attention, as prices dominate conversation, as certainty replaces curiosity, it may be worth stepping back and asking a quieter question. Not whether the metal story is right or wrong, but whether your positioning still reflects the reasons you entered it in the first place. Because the most dangerous assumption in any market isn't that prices can't go higher. It's that they can't move sideways or lower long enough to test your patience, your planning, and your flexibility. The metal story is still unfolding. The system it reflects is still under strain. But stories evolve, and strategies must evolve with them. The challenge isn't predicting the next chapter. It's making sure you're still in control of your decisions when it arrives.